I'll start now. Sorry. And then can you confirm that you can't take a deduction on your federal return and get a tax credit on the AZ return? Take a deduction on your federal return. Yes, correct. Yes. So the question of if you donate here, if you're getting a dollar for dollar tax credit um, on supporting the, say, qualifying charitable organization, you don't get a double dip. So if you give, let's say that you're itemizing on your federal income tax return, uh, you and you give $400 to the public school, you do not get to itemize that on your federal return. Yep. So good question. Yeah, common. I think people often have that question. And yes, if you're giving 400, getting 400 back, nope, no other tax benefit. The federal government, they don't care. No tax benefit for that one, which totally makes sense. All right. So I'm going to switch gears a little away from the Arizona state tax credit stuff here. If you have questions on the state tax credit stuff again, feel free to reference that again. But I'm going to switch away from things that are so timely as filing. Oh, so one other thing I should say. One other thing I should say. These are for tax year 2024. Obviously, it's 2025. So people will ask, can I give now in February of 2025 and have it affect my 2024 taxes? Yes, up until April 15th. Up until April 15th. So this is not a 12/31 deadline on these Arizona state tax credits. You can give to these organizations up until I was going to say up until you file, up until April 15th. If you file an extension, shame on you. Just kidding. Your deadline is still April 15th. All right. So I'm going to change gears. I'm going to go over two of the other pieces here on this Arizona retirement tax guide here. The first I want to highlight is the tab here we call our withdrawal strategy. Just by the way, on this Excel sheet here that you'll have access to, all of the yellow fields are fields that you can edit. If they're not a yellow field, you can't edit them. We did that so you don't mess up all the formulas. Um, so let's say here I already entered some of the info in. We have a pre-tax account balance. So this would be the combination of 401ks, IRAs, 403bs, 457s, things like that. Add all of them up. This hypothetical situation, this person has, say, $800,000 in pre-tax account balances. Then on top of that, they have another 150 in Roth account balances. And then on top of that, they have another 50,000 in just like a joint account or a trust account or a brokerage account. That's a non-retirement account. Okay, so simple, this one here, simple math here. This person has about $1 million or has $1 million in their portfolio, right? Now, you can change all the numbers to be to your specific one here, but this is what we're using here. Separate conversation here. Our default distribution rate here, we're assuming is 4.5%, right? Now that's not bulletproof by any means. Understanding longevity, family health history, what your age is, all that kind of stuff, all impacts like, hey, what's a safe withdrawal rate? What other income sources do we have? Things like that. For this here, I assumed that this person had like a part-time job and they had earned income of $5,000 a year. They had $25,000 a year in Social Security and had a pension for $5,000 a year. So between the 45 here and the other 35,000 between earnings, Social Security, and pension, their total income is $80,000. And what I wanted to illustrate here, again, like I said at the beginning, I don't think anything I'm sharing with you alone, there's no individual concept I'm sharing with you where it's like, I've never heard that before. The combination of several things might be a little different, right? And this concept here that I'm going to share with you, I don't think anyone's going to go, oh, wow, I've never heard that. But distributions from different accounts have different tax consequences. again, I think that's super intuitive. Like if you take money out of your IRA and you take money out of your Roth IRA, those have different tax consequences. Like I think we're probably, kind of aware of that, but here just visualizing it and understanding so you can understand, does it make sense to do one thing? Does it make sense to take distributions from one account more than another at different times in my retirement? And the answer is yeah, it does. So what we illustrated here in these three columns is if we said on that 45,000 in particular, if we focused and said, hey, all of this is coming as a distribution from this pre-tax account, what's the tax consequence look like? Okay, we have 80,000 in total income. All 80,000 of it is taxable. And then we made an assumption for taxes to say that after taxes, in this situation, you have 68,000 left over, meaning you had 12,000 that went to taxes. That's not a perfect illustration, just FYI, we have a couple assumptions for taxes which are not bulletproof in this, but we just wanted to have something as kind of a base. And then on this column here for Roth, we said, well, what if you switched and said all that 45,000 is coming out of Roth? Well, now we have still 80,000 in total income, but only 35,000 is taxable, right? And the difference is because this amount's taxable, the earned income, the Social Security, and the pension, and that distribution from the Roth is not taxable at all. So your after-tax income is 76,500 as opposed to 68. And then the final one here is we said, hey, what if we took a pro rata distribution from each of our three income sources? What does that look like? What if we took a blended distribution? So 80,000 still in total income, 73,000 is taxable, 71,000 is post-tax. The main takeaway I want you to understand in this one here, again, quite intuitive, I think. When we take distributions from different investment accounts, they have different tax consequences, right? So that helps a lot when we're thinking, okay, I'm getting really close to this Medicare Part B premium surtax increasing. You don't want to go over it because that's going to cost me another $120 a month
Yeah.
for both me and my wife. Like that's silly. How can I stay below that? Okay, well, if we still need 45,000 a year, maybe we take 40,000 from our IRAs, but then we take the other 5,000 from our Roth or the other 5,000 from our non-retirement account, right? Again, these are like, I know that this is not necessarily earth-shattering here, but it's just by knowing that information, now you can strategically think and go, oh, aha, yes, I am over that Medicare Part B premium by just a small amount. Let's reposition the way that we're taking distributions. Bill, did you have a question in regard to that?
Yeah, I was going to ask you, Matt, how is RMD fit into this equation?
Perfect. Yeah, that's the next tab here. So,
Oh,
uh,
okay.
thanks for being my planted
Yeah.
my planted attendee.
Yeah.
Um, the let's see, you had one other question here. So do most online tax packages handle the tax credit carryover for future years? Yeah, if you use the same tax software year over year, yeah, actually I said yes. I don't know actually on that one. If I will say that yes, like TurboTax, and if you use like H&R Block
Right, that's what I
as like
use.
online tax software, they have no issue doing the state tax credits. If you give, let's say going back to the example before of you can give 3,000 in tax credits, but you give 4,000, will it carry over that 1,000 into the future year? I'm not, to be honest, I'm really not sure on that one, but I could look it up if you want me to look it up. I could look it up for sure.
Yeah, it's not that important.
All right. Bill's chomping at the bit to learn about the RMDs, so we'll satisfy him and talk through this one here. So this one here again, all the yellow fields you can input. So here I said, hey, this individual was born in 1962, early 60s. They're retiring here in 3 weeks. So bravo to them. And then they're going to take their first their first distribution on April 1st. Same thing before. Their current pre-tax balance here is, and again, on this one here, we're just highlighting pre-tax balance. And the reason why is because of the comment, Bill, that you said, you said before there, is here we're trying to highlight what our future RMD projection may be. Okay. You can enter if you have any contributions, what your monthly distribution is. Thanks, John. And then what you project, how long you're going to live. How long how long is this retirement going to last? And then we put in, we have assumptions here, but you can change them for your assumed growth rate on your portfolio, and then assumed inflation rate here. So on the growth rate, I would say, if you know that your portfolio is more conservative, well, maybe you use a number like 3, 4, 5%, right? If you know that your portfolio is more aggressive, well, maybe you say it's 9 or 10%, right? We use something in between there and just used 8% for our illustration here. And you can see what this looks like. So in 2026, this $2,000 monthly distribution that we're illustrating, that's adjusting with inflation over time. So that's why you see the withdrawals tab here, you see is increasing with inflation. So that what would have been 24,000 in the first year is almost 25 in the next, a little above 25 the following, etc. For this person is age 62. Or 63 rather, by the time that they have to begin RMDs, which for them is their age 75. If you're not familiar, the RMD ages got pushed out depending on when you were born. So for this person, they don't have to begin RMDs until age 75. You can see that their inflation adjusted distribution rate would be about $32,000 a year. But their required minimum distribution in this example here would be a little under $60,000 a year. And if you're not familiar, your required minimum distribution is the amount that the IRS says, hey, you've got all this money sitting in this account, you haven't paid taxes on it yet. If you never take distributions from it, you'll never pay us.
Yeah.
You need to start taking money out, right? And so this is the minimum amount that this individual would need to draw in the future. Now I should acknowledge here, and I think it's kind of somewhat intuitive, but I should definitely acknowledge here, the flaw in looking at data the way I'm presenting it here is that the markets don't grow the way I'm illustrating it.
Yeah. Yeah.
They grow 25% one year, go down 20% the next, gain 5%. It might average 8%, like I'm illustrating here, but that you're going to have some mythical investment that goes 8%, 8%, 8%, 8%. Not likely. Not likely. And the flaw in that is that this balance here is going to have some ups and downs along the way, right? Now, when you have a long enough time period here, like in this example where I'm projecting, their RMDs over the next 12 years, it kind of all averages out a little bit when we start to look at numbers down here. But if we're looking at numbers for next year, well, the market's going to be up or down for the next 12 months. I don't know. It could be up or down. Who knows, right? So anyway, I just wanted to acknowledge that because that's a key assumption that we're assuming here, which is totally and completely flawed. Totally and completely flawed for when we're doing illustrations like that. Markets do not grow in lockstep. But the reason I wanted to highlight the discrepancy between the RMD and what this monthly distribution is for this individual is that they may be taking distributions like this in the beginning, but they totally disregarding that they're going to have this kind of tax time bomb here that's going to go off once they turn 75. Their distributions are going to be nearly double what their need is going to be. And so that transitions into kind of the next piece of um, when do you when is the what are some tax planning strategies here? So I'm going to go back to my slide deck here, and I'll scribble here for a little. All right, you guys can see my black screen, right? Okay. All right. All right. So let's say that uh, the y-axis here is income. And then the X down here is time or years, however you want to think about it. Now I'm gonna use the illustration of this person that was age 62. They're retiring in this year. Let's say their income, well, actually, I'll go back on this person. I'll say let's go back to this person when they were 59, and let's plot their income over the next 3 years and this is a hypothetical person here. Your individual situation is probably a little different than what I'm illustrating here exactly. But presumably, if they're on the latter part of their earnings, their income's probably going up a little bit. And then when they retire, again, depending on their mortgage, depending on their situation, their income probably goes down in retirement. They're not having to put as much into retirement accounts, 401ks, IRAs, etc. And then depending on what they decide to do with their guaranteed income sources, let's say this example, this person, they retired at 62, but they said, you know what, Matt, we're going to delay Social Security until 67, right? Which, depending on your situation, may be a good strategy. The the thing that can be nice about that as far as tax planning is concerned is you can keep your income low, and then as you say over those next 5 years until they start drawing Social Security, their income may rise just a little bit here. And then once they start drawing Social Security, their income may bump up again, rise kind of slowly, and then, oh, whoops, connect the dots here. They had no income there. Rise kind of slowly until they have RMDs again, and then kind of rise slowly throughout the remainder of their retirement. So when we think about tax planning, that like the thing I always like to think about is this, the tax planning in retirement is simply thinking, when do you want to pay the tax? And never's not an option. Do you want to pay it today or do you want to pay it tomorrow? So I often think, let's say for this person here, we know their income here has them in the 22% tax bracket. So, okay, we know the beginning part of this literally kindergarten level math problem is 22% greater than or less than the unknown tax rate of the future, right? Sorry, it's less than or greater than, but less than or greater than the unknown rate of the future, right? So knowing this piece here is really, really important. And knowing this piece is easy because you just look at your previous year's tax return or your current tax year this year to see what marginal tax bracket you're in. And then the only thing that you have to know is, do I think that I'm going to be in a higher or lower income tax bracket in the future, right? And if you think you're going to be in a higher one in the future, which, like, if let's say that this illustration was absolutely perfect, well, their income over potentially the next 5 years might be lower down here, right? But beyond that, we think that they're probably going to be in a higher tax bracket during the latter part of their retirement years. So this person may say, hey, I'm in the 22% tax bracket, but they may say, I would rather pay a little bit more tax today at 22% because I think that my tax rate, I think 22% is less than this unknown tax rate of the future. So I want to pay more tax today. The way that you would do that is one of a couple different things. One, and I kind of boil these down to uh, two different strategies. One would be accelerate income, and then the other one would be defer, or inversely would be decelerate income, right? So accelerating strategies would be things like Roth conversions, distributions. You know, if you're looking and you're saying, well, you know what, we're probably going to buy a new car here over the next 3 years, and that new car, I'd really like to pay cash for it. And, you know, it's probably going to cost us $50,000 to buy this car. I don't really want to take all of that 50,000 out of my IRA all in one year because I'll have to give 20, you know, that might bump me up into the next tax bracket. Well, maybe you say, let's take 20,000 out of it in this year, and then we'll do 30,000 in the year we actually purchase the vehicle. So those would be some acceleration strategies. Other ones would be a strategy called capital gain harvesting, which is the opposite of another strategy called capital loss harvesting. Basically, if you have gains and you're like, hey, I think this is a low income tax year, a low capital gain year, I'm going to go ahead and realize some of those gains because I think I'm in a lower tax situation. And then the inverse here of, you know, opportunities, if instead we thought our income was higher than what it would be in future years, uh, deferral strategies, ideally, this is occurring for someone before they retire. Your biggest one is put money into 401ks, IRAs, things like that. Now, if you are retired, you can still put money into an IRA, but you have to have earned income. Have to have earned income. So that would mean like a W-2 or a 1099 non-employee compensation, things like that. If you don't have earned income, you cannot contribute to an IRA, but you can, and this is, you know, you can do a conversion, right? They sound like the same. Contribution, conversion. So you can take money from your IRA and move it to your Roth, and you do not need earned income for that. But if you want to take money out of your bank account and put it into your Roth, you have to have earned income in order to do that. So um, that is how that works, and that's wonderful. Um, all right, so I think I'm actually, let me stop there for a second on this one. Yeah, and I was just highlighting this period of time, but assuming that I make a scenario like this because for I would say a lot of retirees, this is if you were to plot their income over time, this is pretty close to what it's going to look like. For a lot of people, they're going to have when they retire, their income's going to come down a little bit, and it may drop them into a lower tax bracket. It may not. Um, and then they'll probably stay in that lower bracket. And again, how long that lower income lasts is oftentimes how long they delay Social Security. Or some people, it's like, you know, I don't have a pension that's going to turn on until I get to 65. Okay. So, you know, you're still going to need income during these years here. But where you source that income, you may source that income, like going back to our example here, you may source that income from a non-retirement account because it's not going to be taxed the same as taking distributions from an IRA or a 401k. You may say, hey, we've got 3 years here where our income's going to be relatively low. We're delaying Social Security. Let's just take distributions from our non-retirement account, keep our income extra low, and then that opens the opportunity where we can do larger tax acceleration strategies like Roth conversions and the like, um, so we uh, so we don't end up it, so that the amount that we do in conversions late, or sorry, the amount that we have in required minimum distributions in the future is lower, is lower. All right. I think I'm gonna so this is all the slides you see here. Um, I talked through in my chicken scratch there whiteboard um, presentation. So I'm gonna go ahead and stop there. Oh, Jiminy. And I'll go to my conclusion slide here. I think I have a conclusion. See, look at all this. Look at what you could have had to sit through. I would have talked through all these charts, and instead I just drew on the whiteboard. All right, so let me stop there. Any questions on anything that we talked through? And I think you guys did a good job of just asking questions as they came up. Thanks so much for asking those. As you can tell, I like doing this. It's it's enjoyable for me to talk through these things here. So I appreciate you all attending and asking good questions. As I said at the beginning, the reason that we do these, or the reason that I enjoy doing them, is that advanced financial planning is not really that advanced. It's taking elementary concepts and piecing them together, right? And so hopefully, some of the things I shared with you maybe uncovered some things where if you're doing this stuff on your own, maybe that helps you to get over the next hurdle and just say, perfect, I feel well equipped to be able to do the next piece. Again, if you're in the other camp where you're like, Matt, I'm so glad that you're excited about it. I'm not. Um, um, that's, part of the reason that we do this as well is again, the not so hidden motive of, hey, we charge people to do this.
Yeah.
And if you're looking for someone to engage with, we're a local firm here in Chandler. So if you're looking for someone, we'd love to have a conversation. Um, what are your goals? That's a funny one, yeah. Oh, whoops, yeah. All right, so I will stop there. If you guys have any other questions, feel free to hit me with them. The last slide here has our email stuff. If you want that,
Can you put that in the chat, Matt?
yeah, I'll put, oh, there it is. Um, so our email, info, somemorefinancial.com. Oh, whoops. Sent that just to you, Bill. Perfect. Info@sunmorefinancial.com. So yeah, if you have any questions, I'm happy to take one-off questions. The other, oh, Gemini, we have some neat thing in our slide deck where it just advances to the next one. All right. Info@sunmorefinancial.com. So if you want that calculator, the Excel sheet, just send us an email and say, hey, send me the stuff. We'll send it to you. One thing we do for anyone that comes through these is if you want us to look at your situation, we'll do an hour complimentary meeting where just because you were crazy enough to sit through a webinar that was titled Taxes in Retirement. I mean, God bless you for attending a webinar that had the word tax in it. We're happy to look through your individual situation, hour complimentary, and we would kind of share what our feedback is to you for that as well. So, yeah, one question. Yeah, I'm happy to share our slide deck. That's fine. Tax implications of helping out offspring. I'll share maybe a couple things, and if you want to, you know, I'm happy to talk in as much detail as anyone's willing to share. I understand that when you're talking of a specific situation, sometimes it can be more than you'd care to share on a webinar. So I'll just share kind of generally, and then If you have specific questions that you feel comfortable sharing in front of the group, feel free to share in front of the group. If you have specific questions that you want to take offline, just email us and we'll go through them. But as it relates to, yeah, helping out offspring, a couple things to consider. One, if I assume that you're gifting money or paying bills or something like that, you are, just as far as amount that you can gift without triggering what they call, oh, paying off mortgage. Perfect, thank you. Okay, well, this is yeah. So where I was going to go was say, you can gift so much without triggering gift tax. I'm going to go out on a limb and guess that their mortgage is more than $19,000. But you could gift, let's say that this is a married child, and that you are married. If not, then correct me here. But what you can do, the amount that you can gift without triggering a gift tax is, and I should double check the exact number for 25. I think it's probably, I know it's changed, but I can't remember if it's 19,000 or 19,500. But regardless, it's around 19,000. You could say, my wife's name's Alexa here, so we'll loop her in. Let's say that I wanted to give 19,000 to my brother and his wife. I could give 19,000 to my brother Andrew, and then I could give 19,000 to my sister-in-law Elizabeth. And then my wife could also give 19,000 to my brother Andrew and 19,000 to my sister-in-law Elizabeth, right? So basically, I mean, you can give almost $80,000 a year from one married couple to another, even though the gift amount, the gift exemption amount is around 19,000. You can give almost $80,000 a year without triggering a gift tax. So, assuming that I don't know what, you'd have to think what the mortgage balance was to really think through it. If the mortgage balance was $400,000, you could say, hey, we're going to do it over 5 years, I suppose. Or you could also look and say, hey, yeah, like we're going to gift as much as we can gift and not trigger a gift tax. And then the amount over that, like, we may end up triggering a gift tax. And you just have to kind of weigh what your objectives are and then what the potential cost of doing that might be. So hopefully that sheds a little bit of light. Talia, if you wanted to speak offline on that, happy to talk through that specifically. So cool. You guys have been an awesome group. Thanks for asking questions as we were going through. Bill, go ahead.
Maybe I'm wrong, but I thought if I'm filing married, even though the IRA was taken out from my work when it was a 401k, the computation of the RMD takes into effect both my wife's age and my age. Is that correct?
It will, if your spouse is, so I'm going to say generally the answer to that is no, unless your wife is, I can't remember if she's a certain amount younger than you, like if she's more than 15 years younger than you, then the answer is yes. And I can find out
And
the exact
I,
answer.
fi-
I
I
think
keep
it's,
standard here. I'm 78. I've been picking up my RMDs for 6 years. Barry is turning 73 this year. It's gone to 73. We are now filing to pick up his RMD for this year.
You're filing separate?
No, we filed together, but we are having to register. We're handling the RMD. They're coming in totally separately. The RMDs are totally separate. RMDs get really cute. For instance, well, we have to make adjustments. 6 years between us makes a difference. They compute them totally separately. The RMD for each of us is computed on its own as if we're just single, but that's not having anything to do with taxes.
Well, it has a lot to do
It
with
does.
so, yeah.
Well, yeah. It affects our tax, but the tax situation does not have any determination as to what we have to do about picking up our RMDs.
Yep. Bill, I think if I understood your question, you were asking, is your personal RMD affected by your spouse's age?
Yes,
Yeah.
yeah,
And the answer to that is
Nope.
no. And again, I'd have to look the exact piece, unless your spouse is younger than you by it may be like 15 years or something. And
I think it's 10 years. I
10
think
years.
it's 10 years.
yeah. It just, and the other thing is, Matt, it seems to me the RMD for the following year is based on the balance of your IRA at the previous year.
That's
So
exactly
it
right.
doesn't matter what the market's doing or what your IRA does in the current tax year. It's what it did on as of 12/31 of the prior year, correct?
That's 100%. Yep. Yeah. So you know, like the amount that you'll have to take for tax year 2025, you knew that on January 1st.
Yep.
Right,
You wanted to. Yep.
right.
So
Yeah,
the amount that you'll have to take in 2026 will be impacted by what the market's doing this year.
right.
They call it here, let me be morbid for a second. The IRS word they use, they call it life expectancy factor. So,
Mhm.
the IRS, you may not know how long you're going to live, but the IRS does. And but basically, the amount that you have to take each year, if you think of it as a percentage, it's way easier to think about. What they use is they take your balance and they divide it by this life expectancy factor. But basically, the percentage distribution you need to take each year gets larger each year, which you probably realize that it's not the same percentage. So in your first year that you need to take RMDs, like it's around 4%. But you could see in that illustration here, there's a couple things going on. Like this balance is changing, the IRA balance over time. But then in addition, that life expectancy factor is getting less, which means the percentage is getting larger.
Also, when you're taking out the RMDs, if you know you're going to take out $60,000 in the next year, you can strategically move some of the money into like into cash, right? From like, let's say, a bond fund into cash. So you don't have fluctuations in the next year when you have to take it out, right?
100%. Absolutely. Yeah, that's a great point is that, yeah, I mean, you know that you're going to have a mandated amount that you're going to be taking as a distribution for the remainder of your life if you have a pre-tax or IRA balance. So if the markets go down, like let's say that you have 100% allocated to stock as like a stock portfolio, and then the markets go down 15%, well, just got to
Yeah.
sell it.
Yeah.
Right. So to the point, Mahid, that you said, yeah, it makes good sense to factor that in.
Thanks.
All right. Seeing no other questions. Yeah, thank you all for attending, looking at my chicken scratches. I had a great time. I hope you did too.
Thank you, Matthew. This has been
Thank you.
helpful.
You've been,
All right.
yeah, Matt, you've been very helpful. Thank you so much.
Hey, you bet. All right. Take care, guys.